Lovely. Okay, thank you everyone for joining us today for our December webinar. We've got Kat with us today to give her presentation on IHT planning post UK budget. The presentation we're thinking is going to last around 40 to 45 minutes. It's quite an in-depth presentation today from Kat, which is going to be great for all of you guys who have taken the time to attend. We are going to leave some time at the end as well for a Q&A session. So you should see the chat pod down on the screen to your right. So please pop any messages or questions that you have for Kat in there, and we will get to them at the end. And she will obviously endeavour to answer as many as she can. Please do make use of that, because obviously it's great for us to kind of identify where you guys want to learn more and what themes we can obviously track for future webinars. At the end of the webinar, we will also put a small survey up. So if you do have a couple of minutes just to leave that feedback for us, we will really appreciate it. Otherwise, Kat, I will let you crack on.
Lovely. Thank you, Jess. Okay, and I'm going to apologise in advance. My voice has started to crack this morning, so if I need a drinks break, apologies. Okay, so as Jess mentioned, this is going to be quite an intensive webinar today. It's a big topic, and it's very legislatively challenging, I think, at times to explain without giving specific advice. So I'm going to do my best, and of course, any specific questions will be addressed with your financial advisor over the next couple of years. I anticipate this is going to be the big talking point in our reviews for at least 2025 and probably 26 as well. So this really is designed to be an introduction and hopefully give some context for when you do have those kind of individual and more specific conversations. So as always, you'll get a copy of this, these slides, and also the recording afterwards, just to assist any understanding. And as always, we have our disclaimer in here just to say this is for information purposes. It's not specific financial advice, and the products I'll be mentioning in the solution stage of this webinar are not appropriate for everyone. So on the agenda today, I want to start by setting a bit of the context, which I've just called the who, what, where, when, how and why of inheritance tax, just to set the scene on what inheritance tax is, what legislation we have at the moment, leading in then to what's changing after the UK autumn budget in October. I want to talk about who is impacted and give some examples there, and run through some potential strategies for what might change in your planning. They could be simple strategies all the way up to our more, I'll call them complicated areas of financial planning, such as whole of life, business relief and trust planning. So kicking off with the who, what, where, when and why, this just really, as I say, it's designed to set the scene. So inheritance tax isn't new. Death taxes have been part of UK fiscal policy for years and years and years. And we know the rates, it's 40% inheritance tax. That's not changed for some time either. And it's not forecast to change on the horizon either looking forward. For context, the nil rate band was actually proposed to be increased slightly higher than we have it today, but that never went through. So we still work with a nil rate band of £325,000. And we do have a more recently introduced residence nil rate band of £175,000 per person. Now, the residence nil rate band, as I say, it's a fairly new piece of legislation. It first came into practice in 2017-18, and it was introduced on a phased basis for people who owned property or had sold property since the 8th of July 2015. So importantly, the residence nil rate band still applies to you if you've sold a main residence and you are, say, living in a care home or living in rented accommodation, provided that sale was after July 2015. The residence nil rate band was tapered in. You can see on my screen here the kind of years, the tax years relevant and the residence nil rate band levels, with the corresponding nil rate band, which just frankly hasn't changed at all, showing you then the total tax-free allowance for an individual and the total for a married couple. So looking at today's legislation, because it hasn't changed since 2021, Married couples have £1 million of tax-free allowance they can use to pass on wealth, and that's made up of 2 nil rate bands and 2 residence nil rate bands. Nothing changed with this piece of the inheritance tax regime in the budget. However, Labour have confirmed that from 2030, the inheritance tax limits are looking to be inflation linked, or are being reviewed to be inflation linked, I should say. So potentially we could see some increases in 5 years or so. So thinking about the who and the where, as I say, this is really just for scene setting. And I think it's really important to stress that inheritance tax is typically paid on second death. The kind of normal estate planning setup is that spouse A dies, spouse B inherits, and inheritance tax is then calculated on spouse B's death. Therefore, the residence nil rate band and the nil rate band can be inherited. And they are inherited as percentages as opposed to monetary figures. Therefore, if a spouse passed away today and the second spouse passed away in 10 years' time, but the nil rate band and residence nil rate band have risen, they will reclaim 100% of spouse A's allowance. So if the allowance goes up to 2 million for some reason and it's 1 million today, the surviving spouse will benefit from that increase, even though their spouse has passed away. It's also really important to consider with inheritance tax legislation that for larger estates, planning becomes more complicated. And that is because our lovely residence nil rate band is tapered. So for an estate over 2 million, the residence nil rate band is reduced by £1 for every £2 it's over the 2 million threshold. And that essentially creates a tax trap of about 60%. And if you are a married couple and your estate is over 2.7 million, that residence nil rate band is gone. So it's completely wiped out. So it's really important, that 2 million number, where if possible, if we can do financial planning to get the estate below 2 million and ensure a full residence nil rate band is applicable, that's kind of the best entry level financial planning we can do for inheritance tax. Now, I just want to illustrate that for you because that's quite information heavy. Now in blue, I've got a table here showing an example estate. We have a married couple. They have a property worth 750, cash savings of 200, and ISAs worth £50,000. So that brings their total estate to 1 million. They've got a nil rate band each, and they've got a residence nil rate band each because they're not over that £2 million threshold. Therefore, in their case, they've got no inheritance tax due as they are fully within their nil rate band and residence nil rate band. Developing on that, in this salmony pinky colour, we've increased our property size now to 1 million. Cash and ISAs remain the same, but this means our total estate comes to 1.25 million. We've got the same nil rate band and residence nil rate band, but the taxable estate is now 250,000. So inheritance tax at a rate of 40% becomes 100 grand. So it shows the difference of having £250,000 more in the estate. It's a £100,000 increase for the estate's death duty in the future. Illustrating then the impact of the residence nil rate band, here I have increased the estate size in green. So we've now got a property worth 2 million, cash savings worth 200, but ISA's worth 550. So their total estate is now 2.75 million. The impacts of this are quite dramatic because we've now completely lost our residence nil rate band as we're over the threshold. And therefore the only tax-free part of the allowance is £650,000 for the nil rate band. That means our taxable estate is 2.1 million. Tax then at 40%, 840. So losing that 350 residence nil rate band has quite a significant increase in the overall tax liability for a household. Therefore, where possible, this is why we try and get the estate below 2 million. Now, considering the what, this is going to be the main kind of change in legislation, which I'll introduce in due course. But at the moment, current legislation means that pensions are excluded from the taxable estate for inheritance tax. Now that is changing. I will explain that in due course, but as of today, pensions are excluded. So any death that occurs before the 5th of April 2027, pensions are going to be ignored. Therefore, if I show my example in blue again here, we've got our 750 house, 200 savings, 500,000 in pensions and 50k in ISAs. Even though our total estate is 1.5 million, none of that is taxable because that pension is excluded, and therefore the rest of it sits below our nil rate band and residence nil rate band. So as of today, pensions are excluded. One small nuance I will just raise on this for anyone who does have business relief in the room. Business relief investments that are qualifying, meaning you've held them for 2 years or more, they are inheritance tax exempt. However, they still form part of the estate when we calculate the residence nil rate band. Therefore, if we're trying to get assets below 2 million, business relief isn't the solution because it still falls into that calculation. Again, a bit of a niche comment, but relevant if you are that person already. Now, considering the when, I think this is potentially the part that I find outrages people the most, strangely or correctly, mainly because the requirement for inheritance tax to be paid is quite soon after death, in my opinion. Now, of course, funds from the estate are typically what is used to pay inheritance tax. And this is normally paid by the executor of your will, the executor of your estate, also referred to as an administrator when someone dies without a will. Inheritance tax forms physically have to be sent within 1 year of death to HMRC. However, the executor is required to start paying the tax due at the end of the 6th month after death. So 6 months is kind of the window where executors have to be able to pay an inheritance tax liability without either asking for a postponement or paying a HMRC interest, which, as you can imagine, is higher than what they get in the bank account. So that means that for an estate that is potentially all property, a property is either being mortgaged or sold to cover an inheritance tax liability, which can mean your estate potentially isn't being inherited in the way you want it to be, or a sale is having to happen quite quickly to accommodate that bill, which of course is then potentially against your wishes and what you want to happen with your assets after you pass away. So I just want to make that point again quite clear, which is why some people like one of the products I'll be talking about later, which is an insurance policy to pay the liability. Now the why, and this potentially is the more obvious part of it, the revenue benefit of inheritance tax. Now the Office of Budget and Responsibility, they have forecast that for the 24-25 tax year, inheritance tax is going to raise 7.5 billion. Now I've really struggled to find statistics on how this could increase after the April 2027 legislative change, and I've not found anything yet. But I mean, from my experience looking at my own client bank, I think this is going to be potentially doubling. I mean, there's no statistics I can find to back that up, but I think a lot of households are now going to be dragged in who weren't previously. So I think we're going to see these figures rise quite sharply from 2027. However, if we're looking graphically at this is quite small text, I appreciate, but this is ONS, the Office of National Statistics and the Office of Budget Responsibilities illustration on the revenue obtained by inheritance tax from 1999 through to the last kind of recorded year, which has been 22-23, and forecast in blue for the next couple of years. So we can see just how much that's risen. And mainly due to the fact that inheritance tax bands haven't changed and house prices have gone up about 70% in the same period where there's been no change to the legislation. So it's not the largest kind of fiscal policy, it's not the largest tax for HMRC, it only makes up about 0.7 of their total receipts, which might surprise some people. However, as we can see, it is rising dramatically, and I think will continue to do so in the coming years. Now, I've hinted at some of this already, but I think the main kind of purpose for considering inheritance tax for a lot of people now is going to be the UK budget implications. So the budget has frozen the nil rate band and the residence nil rate band until April 2030. That's the point in which they will be reviewed for potential index linking or inflation linking. I think the reviewed is the important term there. The big one, however, for most households is that from the 6th of April 2027, pensions are going to be included as part of the inheritance tax calculation, part of the inheritance taxable estate. This is technically under consultation. I mean, I think it would be very surprising to a lot of people if this didn't go through. However, there is a consultation in place towards the end of January 2025. This will be written into the finance bill and will be finalised and confirmed. Now, of course, what this does for a lot of people is it increases their taxable estate. It also increases a lot of the complexity for death benefit claims. And it means there's going to have to be a lot more active inheritance tax planning quite a bit earlier in people's financial journey. Again, I'm going to come back to an example just to illustrate this. And in blue, we've got our family we had earlier, where we had our 750 property, 200 in savings, our £500,000 pension, 50 ISAs, so a total estate of 1.5 million. And as we know, as of today, pensions are excluded from the taxable estate. Therefore, the nil rate band and residence nil rate band are covering the taxable aspect. However, from 2027 onwards, pensions form part of that calculation. And therefore, we can see that inheritance tax liability rises to £200,000 because the estate is now over the nil rate band and the residence nil rate band. So someone in this position has a big kind of planning opportunity on the horizon. It's what can you do if inheritance tax is an objective for you? What can you do to get below the million where possible, or reduce the size of the estate that will be taxable on second death? In terms of logistics, I won't spend too much time on this, but in case anyone is kind of intrigued or interested, the logistics are going to be slightly different for how inheritance tax is paid on pensions. So our understanding is that pensions are not going to go through the probate process. Instead, it'll be down to the pension scheme administrator, the PSA. That could be your Fidelity, your Aviva, your Standard Life. They will be liable for reporting and paying any tax due before pension assets are passed to your beneficiaries. When a pension is then inherited, if death occurs after 75, further tax could be due on the dependent. This is normally at their income tax rate. So passing on pensions is going to be a lot less tax efficient than it is today, because essentially most beneficiaries are going to be double taxed. Tax for the inheritance tax and tax for the access at their own marginal rate of income. That being said, there's been no changes to the beneficiary options. So when a beneficiary receives a pension from a loved one, they have the option to do nothing, defer access for a later date. That could be part of their own personal retirement planning. They have the option to take it as a lump sum and potentially pay quite a significant amount of tax for the pleasure, to take out an ongoing income or buy an annuity. So there's been no changes there, but again, logistically speaking, the pension scheme administrator will end up doing the bulk of the work from a reporting perspective. So again, just to reiterate who is impacted in this, and it's going to be anyone now with an estate over 1 million as a married couple, including pension assets. And just to be specific on this, when I refer to pension assets, I'm referring to defined contribution pensions. So this ignores lifetime annuities and defined benefit plans. They are not included as part of the calculation. We also understand that the pensions will form part of the residence nil rate band calculation. So where I mentioned earlier that if your assets are over 2 million, you're at risk of losing that residence nil rate band, pensions will still form part of that calculation, which unfortunately means more people will be due to pay tax anyway, but they will likely have a lower residence nil rate band to offset some of that liability. And again, just illustrating this with an example, in blue I've got my 2024 legislation, where I'm showing a property value of 1 million, cash savings of 200, ISAs at 800, and pensions at 800. So we've got a total estate of 2.8 million. As of today, this person would still qualify, or this couple, sorry, would still qualify for both a residence and a nil rate band, and their inheritance tax liability would be £400,000. However, in this scenario, from 2027 onwards, they've got the exact same assets in their estate, but they've now lost that residence nil rate band. Their taxable estate has risen by 1.15 million, and that tax liability has gone up to 860. So a £460,000 increase to their inheritance tax liability, essentially overnight, from the 5th of April 27 to the 6th of April 27. So it's a damning change, unfortunately. So what can be done? We now get into the challenging part of it all, is that if pensions are the bulk of your estate, and we've been advising you historically, you know, that's the asset to be passing on, because that was previously very sensible planning, we come into a bit of a double-edged sword scenario. And I say that because if you're trying to plan for inheritance tax with just pension assets, and let's say you've used your tax-free cash, you might find that you're paying both income tax for the pleasure of withdrawing the asset and potentially risking inheritance tax as well for a 7-year period, depending on what planning you're doing. So it really feels like a double-edged sword when it comes to financial planning. Therefore, the likelihood is we will still be targeting non-pension assets to begin with, given the tax flexibilities we then have for kind of executing a next step. But all is not lost. There are still strategies we can be employing, from the very simple all the way up to the more complicated. So starting with the simple strategies, these are hopefully things we're all familiar with, starting with the gifting allowance. It's £3,000 per person per year. And I always like to stipulate this is for the donor, not the recipient. So I can't gift 3,000 to 3 different people. I have to gift 1,000 to each of them within the gifting allowance. Of course, if you're married, that doubles. And if you've not used your gifting allowance in the previous tax year, you can carry that forward and use it today. So some people like to do £6,000 every 2 years, which is absolutely fine. Second to the gifting allowance is something called gifting out of normal expenditure. And this is, I would argue, quite an underused bit of legislation, but it's underused because it's very grey and it's quite difficult to qualify for. Essentially, gifting out of normal expenditure is relevant for people who have a guaranteed income. And that means an income they can't manipulate. So it would be an income from something like a state pension and a defined benefit pension, as opposed to a defined contribution pension where they can set the limitations of how much they take out. So if we have our guaranteed income of, say, £50,000 a year, and we're only spending £30,000 a year, you in theory could gift your overage, your 20k a year, to your beneficiaries out of normal expenditure. And what that would mean is that it has an immediate inheritance tax exemption. Now, gifting out of normal expenditure, it has to be repetitive. It can't be like a one-off gift every couple of years. It has to be an ongoing and recorded gift. So typically where this is applicable, gifts are either made monthly or annually, but they are very well recorded and repeated for long-term planning. As mentioned, you have to have quite a healthy base of guaranteed income to qualify for this, but where relevant, it can be a really good asset to reduce the size of the estate. Third on the simple strategy is making a gift, a potentially exempt transfer. This is a gift of unlimited size paid directly to an individual. So there's no limit on the size of this. It could be £1 all the way up to 2 million if your assets allowed it. But essentially that will remain in your estate for 7 years. So anything you gift over the gifting allowance or the normal expenditure rules remain in the estate for 7 years. After that, it's wiped. People like potential exempt transfers because they're very simple. It's an A to B transfer. There's no tax on the beneficiary. It's very kind of clean and simple in that respect. And in theory, if done early enough, the 7-year clock shouldn't be too daunting. The downsides of a potentially exempt transfer are, though, that the asset that is received by the recipient simply becomes part of their estate. So if we're concerned about generational inheritance tax, if we're concerned about asset protection for things like divorce or care assets or bankruptcy, the money that you gift is now part of that problem for the recipient. So potentially some transfers are simple, but for those who want a bit more control and a bit more generational benefit, there are alternatives to making a direct gift. And as always, if you're ever using any of these strategies, my best advice is to keep a gifting log and just store it with your will. So if you have a safe in the house or somewhere that you're storing the will, a simple spreadsheet or even a written out gifting log is just really sensible for assisting your executor in the event of death to make sure they're recording all of your gifts correctly. Because as always, the onus is with the executor here. Probate, if you're not familiar, is in a sense similar to self-assessment. It's on your best understanding of what's in front of you. Now, digging into slightly more complicated areas of planning or slightly more involved areas of planning, and I'll start with the simplest of my options here, which is something called whole of life cover. Now, hopefully you're familiar with kind of the general insurance product market where you pay a premium for a set period and you have a sum assured that is paid out on death at the end of that period or during that period if applicable. And traditionally we use kind of insurance policies for things like mortgage cover, protecting liabilities if we've got a one and a household and things like that. However, we can employ whole of life cover as part of an inheritance tax plan. Now, instead of paying a premium for a fixed term, a premium is paid for life. So in this case, you are kind of signing yourself up to forever paying a fixed rate of premium each month. And then normally that will pay out on second death if you're a married couple, or simply on your death if you're an individual. Now, whole of life cover normally pays into a simple trust vehicle. The benefit of that is it never hits your estate for inheritance tax calculations, because of course the worst thing would be you've paid all of this money into the policy and it then forms part of the problem. But a trust is the very simple way out of that. The benefit of whole of life cover, it's very quick. Payment is typically within 30 days from death. Therefore, this avoids that issue of the 6-month rule for inheritance tax liabilities being due, and is often quite favoured by asset-rich estates, where there is potentially a property that the estate would like to be benefited and not be divided up to pay the inheritance tax bill. Whole of life is simple in the sense that you're not disrupting any of your other plans. You're not changing any ownership, you're not kind of having to gift anything away, and you retain access to all of your assets. However, it can be really, really costly. Whole of life is based on morbidity factors, so things like age and health are considered at the underwriting stage. So as you can imagine, the older you get, the higher these premiums become. Because it's a whole of life policy, premiums are paid for life. If that lapses, everything is essentially lost. So almost worst case scenario here is that you set up this policy with all good intentions. Potentially you lose capacity in your later years and your power of attorney or whoever isn't aware of this policy and the premiums are cancelled. That would mean all of your good planning is now undone. So if someone is setting up whole of life and they don't have a power of attorney who's kind of actively involved, again, I would normally recommend kind of storing with the will your policy information just to make it crystal clear that you have this benefit on file. Now, to give you an example, and brace yourselves, this is an expensive policy, unfortunately, but can be really, really valuable. I'm working on an example of a household with a £400,000 inheritance tax liability. Therefore, they are looking to take out a whole of life policy to cover that £400,000 as what we call the sum assured. These applicants, hypothetically, they're 65 years old, and it's a joint policy designed to pay out on second death of the surviving spouse. In other terms, when inheritance tax is due. The premium costs, as you can see, for this 65-year-old couple, it's £539.80 per month. So if we forecast a 20-year cost, there's a total cost of £129,000. And this premium is paid out monthly for life. This is an example of what we call a guaranteed premium that is going to remain level. That means our £400,000 is in today's money. It's not going to index link, but neither will our premiums. As you can imagine, we can index link that 400k, so it's rising with the cost of living, but premiums will rise alongside it. And for some people, a level cover is absolutely perfect because they're still spending, they're still going to be doing other inheritance tax planning. So it's not necessarily a bad thing if indexation isn't advised, because it's not always required, frankly. Now, again, without overcomplicating the specifics of this in today's webinar, there is an alternative whole of life product on the market that is offered by a company called Vitality. You might have seen the adverts for Vitality. They're quite buzzy. And essentially, Vitality have a product called Optimizer. And the Optimizer product is almost like a reviewable form of life cover, where essentially you will be paying a lower rate of premium, but you're required to log things like your health, exercise, like smoking status, etc., which then keeps that premium low. And they categorize you in from platinum down to bronze. And if you remain in the higher end, the kind of gold or platinum, your premiums either stay the same or actually go down. Whereas if health-wise you drop down to bronze, your premiums rise. Now, for some people, this product's great because the premiums are quite considerably lower, as you can see. And for those who are already healthy and already into kind of tracking fitness, even better. But for those who don't want to be quite as involved and just want to kind of, log off mentally from setting up the policy, it can be a burden. So it's not right for everyone. And typically that means we will quote for both when we're doing specific quotes for this. A question's come in on this, which I'll just answer as we go here, because it is a really good one, which is, can life cover be adjusted depending on the future liability? And the answer is no. Once a premium is set up, the sum assured can't be changed without you going through a new application. Therefore, what we try and do with a whole of life cover is to calculate the eventualities of what your inheritance tax liability could be, both considering potential growth rates and spending. Because the idea being, if you are depleting the estate naturally through spending, hopefully we're not having to index this too much. But unfortunately, the sum assured is set at outset. If your inheritance tax liability rises and whole of life is right for you, it would be a new application with a new product and a new underwriting based on your current health. Taking it away from the insurance market, we move on to business relief. And business relief is an unregulated product, I'm going to start by saying. And when I call it unregulated, that essentially means there's no financial services compensation scheme protection. So there's no FSCS protection. And if the underlying investment fails, you lose your money, simply put. Now, business relief was created in the 1970s, I want to say 76. And the origins of business relief was to enable families to inherit the business activities of their loved ones. And it was kind of your typical like baker, candlestick maker example here. So if someone owned a bakery and they were looking to pass this on to their beneficiaries, business relief could be used to ensure there was no inheritance tax liability on that asset being passed on. And naturally, with all good tax regimes, very clever fund managers found a way to make this a packaged solution. So there are now ways to invest into business relief without being a direct business owner yourself, but instead to invest into trades which qualify. And that's important because not every trade does qualify. For example, if it's like a financial trading company, it doesn't qualify. Hoteliers is another example. But again, taking it back to my bakery example, that would qualify. So there is now a way to invest into this as sort of a packaged solution. So typically this is into assets like agricultural assets or lending. And the benefit is that if you invest and it's qualifying, the assets you have in business relief is inheritance tax exempt after 2 years. So it's quite a quick qualification, which is beneficial if someone is in their latter years, unfortunately put. That being said, I would normally classify business relief as appropriate for someone who is in their kind of later years, but they should still be a balance to a high risk investor. So in that example, the 2-year qualification unfortunately does help people who are needing a quicker qualification. Potentially their health has declined, but they still need to be the correct risk profile. So suitability for us is still really, really important. The benefit of business relief is you can almost think of it as like any fund you invest in. It's liquid, meaning you can still get accessibility to your money. If you've got £200,000 in a portfolio and it is qualifying and you need to make withdrawals for general cost of living or for care, you absolutely can. So very liquid, which is beneficial. In terms of returns, now because these products are designed for people who need that kind of quicker qualification, the 2 years being in mind, you typically find these can be packaged as quite vanilla products with the best will in the world. Therefore, the kind of average rate of interest you could be looking at is between 2% and 4%. And that's frankly because the remit of the fund managers is to try and build a continuously qualifying business relief product that is going to be repetitive and fairly boring with the best will in the world. There are, however, bespoke products out there that can be paying closer to the 5 to 8% a year that would be appropriate for that kind of higher risk investor. So an example of that would be our Sunwood Place product, which is a loaning plan. But if you are someone who is investing directly into things like peer-to-peer lending, and that's via a business, it depends on the qualification by the number of trades you make. But largely speaking, if you have a business and that has peer-to-peer lending in, and that's its main activity, that should be inheritance tax free after 2 years of qualification. Now, again, one change that we had in the budget was there was a cap put in place on business relief qualification, and that cap is 1 million per person. If you have more than 1 million in business relief assets, it is a lower rate of inheritance tax. It's at 20%, but that cap is in place. It's no longer completely inheritance tax free, regardless on size. Again, jumped onto this slightly early, but as mentioned, business relief or BR is limited to the 1 million per person, and assets that are over the 1 million threshold will pay a reduced rate of inheritance tax at 20%. This is applicable from April 2026, so it's not immediate. So there is potentially some planning opportunities if you fall into this camp in the next year or so. And that potential planning opportunity is, again, a very complicated one, but it involves putting business relief assets into trust. And this is currently under consultation, so I'm not going to delve into it too much, but there is the potential for using a existing trust to increase that 1 million per trust asset. We've done quite a few technical calls on this. We are quite involved in how we could use this for our applicable clients. But until the consultation has gone through in hopefully the first quarter of next year, I won't say too much more for now. So business relief, a potential solution. Benefits, again, to reiterate, is the liquidity, the flexibility it brings, and the lower qualification period. But the downsides are potentially lower returns than a traditional investment, and that it's unregulated, so it's not right for everyone. Now, this takes me on to trusts, and I could talk about trusts all day long, sadly, because it's a very big area and there's lots of different nuances and variations. So I aim to give you a kind of snapshot today. Now, gifting assets into trust. Typically, an asset gifted to trust after 7 years is inheritance tax-free. And when you set up a trust, you set up all of the terms. So you are classed as the settler, and the settler dictates any limitations. So a typical limitation we might see is setting up a trust for the benefit of grandchildren, and that the asset has to be used for, say, education or house deposits. And that's up to you as the settler. And in the event you've opened a discretionary trust, you maintain a level of discretion over what can be done with that money. That means as long as you're mentally capable, you can change your beneficiaries, you can change your limitations. So that, again, is a popular trust vehicle for that reason. Alongside you as the settler, there are additional trustees employed to help manage your wishes. These can be professionals. It's not right for everyone. In my experience, professional trustees are sometimes hard to work with and can be very, very expensive, but in some situations very needed. Otherwise, trustees could be family members, and they could even be beneficiaries if you choose them to be. Trusts can be set up on a couple of different bases. It can be that you just gift money to a trust and forget about it. You're never going to see it again, unfortunately or fortunately. Or they can be set up to provide you an income, which I'll explain in more depth in a moment. Now, trusts are typically opened with cash assets, and a very popular question we get asked is about moving property into trust. So my second slide to this one will be looking at that specifically, but typically trusts are open with cash. As a side note, if you do have a trust or you're thinking about opening a trust, please be aware there is a HMRC requirement now called the Trust Registration Service that essentially requires any trust that's created to be registered with HMRC to log the size of the gift, who the trustees are, and who the settlor is. It's a simple service, but it's something really important to be aware of, because if you don't do it, there are fines from HMRC applicable. Now, gifts with reservation, I'm just going to kind of float over this the best way I can. But as I say, a very popular question I get asked is, well, why can't I just gift my main residence to a trust? And I think someone once asked me this in a pub, and I went on at them for about an hour on why it's not good financial planning. So again, very sad, but it's a popular question. And essentially, gifting a property to a trust and retaining benefit by living in it falls under something called a gift with reservation rule. And the only way to therefore qualify for inheritance tax-free benefit of gifting a property to a trust is to pay an effective market rent for the main residence to your beneficiary, which, if your assets are big enough that you need to be doing inheritance tax planning, I can imagine as would be your rent. And that market rent, of course, is then taxable for the beneficiary, which again is a downside for them. And the beneficiary has to consider that they now own a property, therefore they've got capital gains tax considerations, they've got stamp duty, land tax kind of considerations. If they move, it's deemed an additional property. For holiday homes, this can sometimes be a bit more flexible. If you gift a holiday home to trust, you are deemed to be reserving benefit if you benefit or visit it for more than 2 weeks per year. If you go with the new owner, the trustees, for example, the rules are slightly looser. So holiday homes, there is some flexibility, but main residence, in 99% of cases, it doesn't work, frankly. Taking it back to trusts, there are 2 key types of trusts that you need to know about to begin with for context here. The first is something called a bare trust. This is also referred to as an absolute trust for completeness, but a bare trust is under the potentially exempt transfer rules. This means there is no limit on how much you can gift to a bare trust. It is classed as a gift to a recipient, but with a trust in between to hold some element of control. So typically these are used where a gift is being made to a child, potentially they're under 18 or under 25, whatever remit you put in place. And as soon as they reach that qualification age, they become the automatic owner. Bare trusts are something we've not done too much of in the past because legislation hasn't required us to, but I think this could be a really useful vehicle going forward. The inheritance tax exemption is the same, it's still 7 years to qualify, but these can be used alongside discretionary trusts to kind of use both kind of benefits together. But a really kind of simple version of a trust, trust is taxed on the beneficiary and it is kind of automatically theirs at the set age, as I mentioned. That then compares to a discretionary trust. Excuse me. The difference with a discretionary trust is it falls under something called a chargeable lifetime transfer. And that means there is a limit on how much you can gift. And that limit is £325,000. If you gift more than 325 to a trust as an individual, you pay 20% lifetime tax for the pleasure. If you gift jointly as a married couple, it's 650 or above, and then you incur a 20% lifetime tax. So this is again potentially where discretionary trusts and bare trusts can work really well together. But the reason you might do a discretionary trust is because you're gifting below 325. You also benefit from more control. Again, you have the discretion unless you lose mental capacity. There's also that generational inheritance tax benefit. It doesn't form part of our recipient's estate. Therefore, if their estate is already sizable, we're not kind of increasing their inheritance tax problem. And once again, it's inheritance tax exempt after 7 years. One just point to be aware of, again, it needs kind of a whole discussion in its own right, but if you do have a trust and it's over the nil rate band, over the 325, every 10 years there is something called a trust anniversary charge, or periodic exit charge, and that's a 6% tax. So only applicable if your trust is over 325. Again, apologies, this is a very complicated area, so I'm hoping this is going in. But we've got our two types of trust, our bare trust and our discretionary trust. And within those vehicles, we can employ certain types of instruction or certain types of sub-trust. The first is a family gift trust, which is very simply, you give money to a trust, you set the limitations or discretions where applicable, but you remove your access. So you can never benefit from what you've placed into the trust, but your beneficiaries have access as per your rules. This is useful where you don't need the money, put frankly. It benefits from inheritance tax exemption after 7 years, and it is completely protected for things like care assessments. So it's your simple form of trust. Complicating that is something called a discounted gift trust, which is probably one of my favourite trusts if I can have one. A discounted gift trust is one where you retain an income from the asset. So typically this is at a rate of 5%. So whatever you put into the trust, you can get 5% out of that vehicle every single year tax-free. And that's based on the capital you invest. It's not an increasing amount, unfortunately. But if you put in 100k, you can get 5 grand every single year for 20 years tax-free. And the 20 years is relevant to you withdrawing 100% of capital. So the benefit there is that you're hopefully going to be able to increase your income or maintain your income throughout retirement, but remove capital from your estate. So I typically recommend these vehicles if someone is, say, selling a buy-to-let property, and they might be selling to do some inheritance tax planning, but of course their income has now dropped, so they want a vehicle that's going to both be income paying and inheritance tax efficient, and this is exactly that. So a really, really good product, I think. Benefit of the income, but you can't access the capital. Now, this is where discounted gift trust gets slightly more complicated, but because you are taking an income out of the product every single year, your 5%, HMRC acknowledge a discount. So they acknowledge that because benefits are going to be coming back into the estate, it would be unfair for them to class the value of your gift as the entry price to the trust. Let me illustrate what I mean. So again, quite small text here, but this is an example of someone who is opening a discounted gift trust for £300,000. They are 70 years old and they're going to be taking their 5% tax-free income, £15,000 annually. Now, because they're going to be taking this money back into their estate, in theory spending it, but it could be accruing, HMRC acknowledge that the value of their gift should not be recorded as £300,000, but it should be discounted to £152,000. After 7 years, this gift is outside of the estate completely, but in the meantime, we get an immediate benefit. Again, to illustrate this, because it is quite complicated, in blue, I've got my pre-DGT scenario. This person has a total estate of 1.75 million, and they have an inheritance tax liability of 300,000. With the discounted gift trust, we can see that they have now sold their ISAs, their £300,000 in ISAs, and in green here, they have put £300,000 into a DGT. That DGT has its immediate discount, which we can see noted here. Therefore, their taxable estate has gone down to 602,000, and the tax liability has gone down to 240. So they've got an immediate saving of around 60k just by setting up the trust. There's literally from day 2 that would be beneficial. And then in 7 years' time, the entirety of that capital is outside of their estate. And in this scenario, their tax liability falls down to 180. So it's a really, really good product for just maintaining benefit from your assets whilst the capital is excluded, plus has this enhanced benefit of the discounting factor. So I really like this product. Now, appreciate I'm running a bit slower than I thought I would. So I just want to highlight my final slide here on retirement modelling, because I think it's really important when we talk about inheritance tax planning to make sure that first and foremost your needs are met. You know, there would be no point putting a load of assets into trust or into a product that then you can't benefit from, and then realising that you're unable to afford your outgoings. Therefore, I think retirement modelling and retirement spending is really important to understand before you enact any planning. So I always like to make sure that we are firstly planning for what do you need. If there is an excess, great, we can talk about inheritance tax planning. But otherwise, I will always tell people the quickest way to save inheritance tax is spending. And no, I don't mean spending and accruing another assets, but I mean going on that extra holiday. Everything's at a 40% discount, if you like to argue it that way. So really important to make sure your retirement modelling is sorted first, and that you limit any tax risk that way. Now, apologies, like I say, that ran over, so I'll hand back over to Jess for the Q&A.
Thanks, Kat. That was a great, very detailed presentation. We have got a couple of questions, but guys, if you want to keep popping them in, the chat box is still live. So let's have a little look. So the first question we had was from Richard, and he asked, is there any discussion ongoing around whether the residence nil rate band would apply to single people with no direct descendants?
Sorry, I just realised I can't. Oh, I can see that question. So at the moment, the residence nil rate band is only applicable if you are passing on assets to a direct descendant. And that was extended to include things like stepchildren and adopted children. But if you are passing a property to someone outside of the direct descendant rules, at the moment, there is no residence nil rate band option available to you. So you only get the residence nil rate band if your property assets are going to a direct descendant. My understanding is there hasn't been much discussion on that in a couple of years. Like I say, I think it was 2019 they extended the legislation to adopted and stepchildren. Since then, I've not heard much on the matter. So I think under this current government and given the fiscal pressures, I'd be surprised if that changes, frankly.
Okay. And then we had, can life cover be adjusted depending on future liability?
Yeah, I answered that, I think, as we went. The answer being no, unfortunately. The sum assured is fixed, but you can take out additional cover. Downside of that, though, is that if your health is deteriorated or if you're older, the premium will be higher, unfortunately.
What about third-party pension contributions as a way to gift liabilities?
You could do that. It would still be a potentially exempt transfer. So yeah, if you were gifting to someone else's pension scheme as a third-party contribution, it would still be a gift. It would still be a potentially exempt transfer. I would say, just thinking off the top of my head on this one, your considerations are how that impacts the beneficiary as well. You know, what do you want that gift to be? Is it part of your beneficiary's inheritance tax? Retirement planning? If so, great. But we've just got to be aware that it's still going to form part of their inheritance tax calculation. So if you're trying to avoid that generational risk, something like a discretionary trust could be better. But if you do this, it would be a potentially exempt transfer for 7 years.
I don't think we actually have any other questions at the moment that have come through. Everyone is just saying it was a great presentation. So if anyone does think of anything after the webinar, obviously I'm sure you can reach out to Kat directly, or you can obviously email us with any questions, and we would obviously be happy to help. As usual, you will receive a copy of the presentation and slides as well, so obviously go over at your leisure. They will be emailed out usually within 24 hours, and a link as well to the video. I am going to pop a small survey up, so if you do have a moment of time just to leave your feedback, then we will really appreciate that. Otherwise, we will see you at the next one, and wish you all a very Merry Christmas and a Happy New Year.
I'll answer that final question just whilst we're still here, if that's all right. So Israel, you've asked if gifts over 325 into a bear trust are still a pet, and yes, they are. Anything into a bear trust is still a pet, a potentially exempt transfer, sorry. So there's still no limitation on a bear trust gift.
Lovely. All right. Thanks, Kat.
Thank you.